Adani's robust presence in renewable energy and infrastructure further enhances their attractiveness. However, potential investors should tread carefully. The company faces legal and regulatory challenges that could impact its reputation and operations. It's essential to dive deep into the complete prospectus before making any decisions. Balancing opportunity with caution is key in today's financial landscape.
Welcome to our in-depth analysis of Southern Petrochemical Industries Corporation Limited, or SPIC, as we explore its investment prospects for the fiscal year 2023-24. In this video, we'll provide a comprehensive overview of SPIC's financial performance, potential risks, and opportunities, helping you make an informed investment decision. Let's begin with SPIC's strengths. Despite a challenging year, SPIC has maintained its commitment to shareholders by declaring a dividend of 1.50 per share. This move reflects a degree of financial resilience and a commitment to returning value to investors. Additionally, SPIC's strategic shift towards natural gas operations is a forward-thinking approach, aligning with global trends towards cleaner energy sources. However, it's crucial to acknowledge the weaknesses. SPIC reported a revenue drop to 1,962.66 crore and a profit after tax of 87.91 crore, both significantly lower than the previous year. These figures highlight the financial hurdles SPIC is currently facing, which potential investors should consider carefully. Now, let's explore the opportunities. The transition to natural gas, while challenging, presents a significant opportunity for SPIC to modernize its operations and potentially reduce costs in the long term. This shift could position SPIC favorably in the market as environmental regulations tighten and demand for sustainable practices increases. On the flip side, we must consider the threats. Production issues have been a persistent challenge, and the transition to natural gas operations introduces additional risks. These factors could impact SPIC's ability to meet production targets and maintain profitability in the short term. In conclusion, investing in SPIC requires a balanced perspective. While there are clear challenges, including financial performance and operational risks, there are also promising opportunities through strategic shifts and dividend declarations. As always, assess your investment goals and risk tolerance before making a decision. Thank you for joining us in this analysis. If you found this video helpful, please like and subscribe for more insights into the financial world. Stay informed and happy investing. Welcome to the annual report presentation of Geo Financial Services Limited for the fiscal year 2023-24. Today, we embark on a journey through JFSL's remarkable achievements, strategic initiatives, and future aspirations, all underpinned by our unwavering vision to lead in digital financial services. At the heart of JFSL's success lies a robust financial performance. This year, we proudly report a consolidated profit after tax of 1,605 crore, with earnings per share reaching 2.53. Our strong capital base, with a net worth of 1,039,148 crore, positions us as one of the most capitalized financial service platforms globally. These figures not only reflect our financial health, but also our commitment to delivering value to our stakeholders. Strategic partnerships have been pivotal in our growth narrative. Our joint venture with BlackRock, Inc. marks a significant milestone in democratizing investment and wealth management services in India. This collaboration is set to unlock immense growth potential in the asset management sector, leveraging BlackRock's global expertise and JFSL's local insights. In our pursuit of innovation, JFSL adopts a digital-first approach, harnessing cutting-edge technology to offer seamless financial services. This strategy aligns perfectly with India's burgeoning digital economy, positioning us to capitalize on the vast opportunities it presents. As we look to the future, our market potential is vast and promising. JFSL is expanding its footprint across key sectors such as lending, payments, insurance, and wealth management. Our mission is to drive financial inclusion by offering accessible and affordable financial solutions, particularly targeting underserved markets in India. This focus not only broadens our reach, but also aligns with our vision of inclusive growth. However, navigating the financial services landscape is not without its challenges. The competitive market, with established players like HDFC, SBI, and ICICI, demands constant innovation and agility. Moreover, as a systemically important financial services company, we are subject to stringent regulatory requirements. These factors necessitate a proactive approach to risk management, ensuring that we remain resilient and adaptable. Despite these challenges, JFSL stands as a compelling investment opportunity. Our robust financials, strategic joint ventures, and clear focus on digital financial services underscore our potential for growth, particularly in the asset management and lending spaces. Our commitment to financial inclusion further enhances our appeal, promising substantial returns for our investors. In conclusion, JFSL's journey is one of visionary leadership, innovation, and growth. We are poised to redefine the financial services landscape in India, driven by our mission to empower every Indian with accessible financial solutions. As we move forward, we invite you to join us in this exciting journey, confident in our ability to deliver sustained value and growth. Thank you for your attention and continued support. Together, let's build a future where financial services are not just a privilege, but a right for all.
Investing in HUDCO could be a promising opportunity. Their latest revenue figures show a robust rise to Rs 7,784.29 crore, with a profit after tax of Rs 116.74 crore, an impressive indicator of solid growth. They've sanctioned loans totaling Rs 386.55 crore, which is a staggering 235% increase. This kind of expansion is noteworthy. Plus, with an 8IA rating, the risk seems relatively low. However, it's essential to keep an eye on their rising debt levels. As an investor, it's crucial to align this potential with your own investment goals. Balancing risk and reward is key to making informed decisions. TGV SRAAC Limited's 2023-24 annual report presents a mixed bag for potential investors. Revenue has dipped to Rs 1,545.96 crore, and net profit has taken a significant hit, falling to Rs 60.29 crore. While the company has declared a Rs1 dividend, the declining profitability raises red flags. On a brighter note, their expansion into chloromethanes and solar initiatives could signal future growth. However, the risks associated with these ventures cannot be overlooked. It's essential to assess your risk appetite carefully before making any investment decisions. Balancing potential rewards against these challenges will be key to navigating this landscape. Ashoka Buildcon Limited is at a pivotal moment, showcasing impressive growth through major projects like a $150 million solar power plant and significant highway expansions. Their recent win of a Rs 662.55 crore contract for a link road to Navi Mumbai International Airport highlights their potential in a booming infrastructure sector. With the Indian government's strong focus on renewable energy, Ashoka Buildcon is well positioned to capitalize on this momentum. While we await detailed financials, their consistent project wins signal a robust stability and growth trajectory. For investors, this is a company to watch closely as it navigates the evolving landscape of infrastructure development in India. Jio Financial Services Limited presents a compelling investment opportunity. With a profit after tax of Rs 1,605 crore and a robust net worth of Rs 139,148 crore, JFSL is making waves in the financial sector. Their strategic partnership with BlackRock aims to democratize wealth management in India, tapping into a rapidly growing market. What sets them apart is their digital-first approach, which enhances accessibility for underserved segments of the population. This positions JFSL not just as a financial player, but as a catalyst for change in wealth distribution. With strong fundamentals and significant growth potential, investing in JFSL could be a smart move in today's dynamic market. Gallant Ispat Limited, or GAL, has truly made waves in the financial landscape for FY 2023-24. With an impressive 23.8% increase in EBITDA and a staggering 62.5% rise in PAT, GIL is clearly on an upward trajectory. This growth is driven by the surging demand from infrastructure projects, positioning GIL as a key player in the steel sector. What sets GIL apart is its unwavering commitment to sustainability. The company prioritizes clean energy and adheres to robust ESG practices, ensuring that growth does not come at the expense of the environment. With ongoing investments and a positive outlook, GIL presents a compelling opportunity for investors looking to capitalize on a company that not only excels financially, but also champions responsible business practices. Vodafone Idea Limited's FY 2023-24 report paints a nuanced picture for investors. Revenues have reached Rs 426,517 million, indicating slight growth. But the stark reality is that net losses have surged to Rs 312,184 million. This raises significant concerns, especially with debt now towering at Rs 276,298 million. The company is expanding its 4G services and gearing up for 5G, which is promising, yet the competitive landscape is fierce. Financial instability is a major red flag. As investors, we must tread carefully, weighing the potential of technological advancements against the backdrop of high debt and ongoing losses. This complex investment landscape demands a thorough evaluation before making any commitments. Investing in Southern Petrochemical Industries Corporation Limited requires a careful look at their recent performance. With revenue dropping to Rs 1962.16 crore and profit after tax down to Rs 87.91 crore, the numbers raise some red flags. They did declare a Rs 150 dividend, which is a positive sign, but we must consider the underlying issues. Production challenges and a heavy reliance on natural gas could pose significant risks moving forward. However, there's a glimmer of hope. Potential efficiency improvements might stabilize their operations. As you weigh these factors, think about how they align with your investment goals. It's a balancing act between risk and reward, and every decision counts. Madhav Infra Projects Limited has encountered significant hurdles in FY 2023-24. Standalone revenues have plummeted to Rs 363.09 crore, while consolidated revenues are down to Rs 466.51 crore. This sharp decline in revenue is mirrored by a notable drop in profit after tax. In light of these challenges, the company has opted not to declare dividends, instead choosing to retain earnings to fuel future growth. With a CARE BBB credit rating, the risks are becoming increasingly apparent. Although MIPL boasts a diverse project portfolio, external economic factors pose a real threat to project execution. Investors should remain vigilant as we navigate this complex landscape. Hyundai Motor India Limited is on the brink of a significant milestone with its first initial public offering over 142 million equity shares. This move is backed by Hyundai Motor Company, a global automotive leader, which adds a layer of credibility. However, potential investors should tread carefully. The absence of an existing market means future price movements are uncertain and inherent risks are involved. On the upside, HMIL has established a robust presence in India's automotive sector and is making strides into the electric vehicle market. This expansion could position them favorably as the industry evolves. Balancing these factors will be crucial for anyone considering this investment opportunity. Lemon Tree Hotels Limited has demonstrated remarkable growth, with a 23% increase in revenue, now reaching 1,076.8 crore. Their profit after tax has surged by 29%, even as they continue to invest in renovations. The company is strategically expanding, targeting over 120 hotels by FY25, all while emphasizing sustainability and inclusivity. However, it's important to note that high debt levels could pose risks. As the hospitality sector rebounds, Lemon Tree Hotels presents a compelling investment opportunity. Yet, potential investors should carefully weigh these risks against the promising growth trajectory. Investing in National Aluminium Company Limited, or NALCO, demands a thorough analysis of its 2023-24 annual report. Revenue has dipped slightly to Rs 13,149.15 crore, but here's the silver lining. Profitability has surged to Rs 2,059.95 crore. This indicates a remarkable resilience in challenging market conditions. The company has achieved record production levels and impressive export figures, showcasing its operational strength. However, we must remain cautious. The revenue decline and ongoing market volatility present notable risks. It's crucial to assess your investment strategy carefully, weighing these factors before making any decisions. Balancing potential rewards against risks is key in navigating this investment landscape. Shipping Corporation of India Land and Assets Limited has demonstrated remarkable financial growth, with revenues skyrocketing from a total 34 lakhs in 2021-2022 to an impressive 9894 lakhs in 2023-2024. While there was a dip in profits during 2022-2023, the rebound to Rs 330 lakhs showcases effective cost management strategies. The company's valuable real estate assets and commitment to maritime training position it strategically for long-term growth. Additionally, the declared dividend of Rs 0.66 per share reflects a strong commitment to returning value to shareholders. This trajectory not only highlights the company's resilience, but also its potential for sustained success in the maritime sector. Considering investing in Oil India Limited? Let's break it down. For the fiscal year 2023-24, we saw a slight dip in standalone revenue to Rs 24,514.28 crore, while consolidated revenue fell to Rs 37,646.48 crore. Profit after tax also took a hit, landing at Rs 5,551.85 crore for standalone operations. Despite these short-term revenue concerns, the company remains profitable. What's particularly interesting is their strong dividend payouts and a growing focus on renewable energy, which could signal long-term potential. While the immediate numbers might raise eyebrows, the strategic shift towards sustainability could position Oil India Limited favorably in the evolving energy landscape. Keep an eye on this one. NPR Finance Limited's latest annual report paints a complex picture. Revenue has dropped significantly from Rs 1,274.33 lakhs to Rs 946.61 lakhs, primarily due to a decline in income from share sales and the closure of its wind power segment. However, amidst this decline, the company has managed to turn a profit of over 108.63 lakhs, marking a notable recovery from last year's loss. This turnaround suggests that cost management strategies are taking effect. Yet, we must remain cautious. The loss of Rs 258.23 lakhs raises red flags about sustainable income. Investors should carefully consider these dynamics, as the declining operational revenue could signal potential challenges ahead. Investing in Saj Hotels Limited's IPO could be an intriguing opportunity, especially with the tourism sector bouncing back post-pandemic. Their operational resorts, like Saj on the Mountains and Saj by the Lake, seem poised to generate steady revenue from bookings and dining. However, it's essential to approach this with caution. The financial data available is limited, and without any prior stock performance to analyze, we're stepping into somewhat uncharted territory. They're offering 42,050 shares, but we must consider the risks involved. Market acceptance is uncertain, and economic fluctuations could impact their growth. While the potential is there, it's crucial to weigh the excitement against the reality of these risks before diving in. Investing in Divyadan Recycling Industries Limited presents an intriguing opportunity within the expanding recycling sector. The company specializes in recycled polyester staple fiber, a product that meets the rising demand for sustainable materials. While we lack specific revenue and profit after tax figures, the potential for growth in this eco-conscious market is significant. However, it's crucial to approach this investment with caution. The absence of detailed financial data and the inherent uncertainties of the market could pose risks. Therefore, a thorough evaluation of both the opportunities and challenges is essential before making any investment decisions. Mamba Finance Limited presents a compelling opportunity in the expanding non-banking financial company sector. Their draft red herring prospectus reveals consistent growth in vehicle financing and personal loans, which is promising. As the market for personal mobility continues to grow, Mamba is well positioned to capitalize on this trend. However, it's important to approach this first public offering with caution. Investors should be mindful of the inherent risks, including market volatility and the lack of historical trading data. Balancing the potential for growth with these risks is crucial for making informed investment decisions. Investing in KRN Heat Exchanger and Refrigeration Limited is a decision that requires careful thought. The company is positioned in a growing sector focused on energy efficiency, which is promising. However, the absence of detailed revenue and profit after tax data raises some red flags. This lack of transparency can make it challenging to gauge the company's true financial health. The upcoming IPO certainly presents potential opportunities, but we must remain cautious. Market volatility can significantly impact new offerings, and it's essential to weigh the risks against the potential rewards. Staying informed and analyzing the available data will be crucial as we navigate this investment landscape. Proceed with caution and ensure you have all the insights before making any decisions. Hyundai Motor India Limited has truly set a benchmark in the automotive sector with its remarkable growth trajectory. In just 9 months ending December 31st, 2023, the company reported a staggering revenue from operations of Rs 21,579.11 million, largely fueled by robust vehicle sales. Looking at fiscal year 2023, total revenue soared to Rs 603,075.80 million, a significant leap from Rs 473,184.32 million in 2022. This impressive growth is a testament to Hyundai's strategic expansion and unwavering commitment to innovation. The strong demand for their vehicles underscores their focus on customer satisfaction, positioning them as a formidable player in the competitive automotive landscape. It's clear that Hyundai is not just keeping pace, but is actively shaping the future of the industry. Ola Electric Mobility Limited is truly making waves in the electric vehicle sector, and I couldn't be more excited about it. Their focus on eco-friendly transportation is not just a trend, it's a movement towards a sustainable future. While we may not have specific revenue figures from their draft red herring prospectus, the ambition to raise Rs 55,000 million through their IPO speaks volumes about their growth potential. The electric vehicle market is booming, and investing in Ola could be a golden opportunity for those who believe in the future of sustainable technologies. With their innovative approach and commitment to green mobility, Ola is positioning itself as a strong contender in this dynamic landscape. The future is electric, and Ola is leading the charge. Investing in Diffusion Engineers Limited requires a careful approach. While we lack specific revenue and profit after tax figures, the company operates in welding consumables and heavy engineering, suggesting a diverse revenue stream. Their recent IPO signals potential growth, particularly in the booming infrastructure sector. However, the absence of historical stock performance means we should tread cautiously. It's essential to analyze industry trends and wait for detailed financial data before making any commitments. Remember, informed decisions are key in navigating the investment landscape. Proceed with diligence and patience. Investing in Western Carriers, India Limited presents an intriguing opportunity. Their IPO is offering over 28 million shares at Rs 172 each, aiming to raise nearly Rs 5,000 million. This company operates in the rapidly growing logistics sector, providing a range of services that cater to diverse needs. However, it's essential to note that they lack a market history, which introduces potential volatility. While the promise of infrastructure developments is enticing, it's crucial to weigh these risks carefully. Are you ready to explore this opportunity, or will the uncertainty hold you back? The decision lies in balancing potential rewards against the inherent risks. Ola Electric Mobility Limited is set to launch its IPO, offering 808 million equity shares and aiming to raise around R6,145 crore. This move comes at a pivotal time in the electric vehicle sector, which is experiencing rapid growth, fueled by government incentives for green energy. While the potential for growth is substantial, it's crucial to consider the risks involved. The EV market is competitive, and stock volatility can be a concern for investors. If you believe in the future of electric vehicles and are prepared to navigate the inherent risks of an IPO, Ola could be a valuable addition to your investment portfolio. Just remember to keep a close eye on their financials after the listing to ensure it aligns with your investment strategy. Investing in Orient Technologies Limited could be an intriguing opportunity. They're offering over 10 million equity shares at Rs 206 each, aiming to raise funds for expansion in the rapidly growing IT infrastructure and cloud computing sector. This is an area that's booming, and their focus here is promising. However, it's essential to tread carefully. The lack of prior performance data raises some red flags, and the competitive landscape is fierce. While the potential for growth is enticing, it's crucial to conduct a thorough analysis before diving in. Balancing optimism with caution could be the key to making a smart investment decision. ECOS, India. Mobility and Hospitality Limited is set to launch an IPO of 18 million equity shares, aiming to raise R6,012 million. While the mobility sector is on the rebound post-pandemic, it's crucial to note that this offering primarily benefits existing shareholders rather than fueling new growth initiatives. As an investor, you need to weigh the potential gains from a recovering industry against the inherent risks of a first-time public offering. The market is buzzing with optimism, but remember, the IPO landscape can be unpredictable. Ensure your investment strategy aligns with your risk tolerance and long-term goals before diving in. Investing in Premier Energies Limited IPO presents an intriguing opportunity in the solar energy sector. With an impressive offer size exceeding R28,000 million and a share price of R450, this company is well positioned to capitalize on the growing demand for renewable energy. Their robust manufacturing capabilities give the edge essential to consider involved. Notably, a significant of the IPO shares related to existing investors, which means all those raised will be directed towards. While the renewal holds great promise, factors is crucial. Limit for 3 and 6 at Rs in each, so operates in diverse sectors facing. However, positions high city are the with an eye at fueling growth and offer for sale that benefits existing shareholders. FirstCry is strategically positioned to capitalize on rising incomes and the booming e-commerce landscape, making it a strong contender in a competitive space. However, potential investors should carefully consider the risks involved. Market competition is fierce, and a significant portion of the shares will primarily benefit current stakeholders. Balancing these factors is crucial for making an informed investment decision. The National Stock Exchange of India has truly outdone itself in the 2023-24 annual report. With a consolidated revenue of Rs 433 crores, we're looking at an impressive 28.74% growth. The profit after tax stands at Rs 8,305 crores, marking a solid 12.91% increase. These figures highlight the exchange's strong financial health. The EBITDA margin is a remarkable 70.73%, showcasing robust profitability that investors can trust. With a market capitalization soaring to Rs 382 lakh crores, the NSE is now the fourth largest stock exchange globally. It continues to lead as the largest derivatives exchange and dominates equity cash trades. Office Space Solutions Limited IPO is set to offer 15.6 million equity shares at Rs 383 each, amounting to nearly Rs 6 billion. As a frontrunner in India's co-working sector, Office serves a diverse clientele, from startups to established enterprises. However, it's crucial to note that a significant portion of this IPO involves existing shareholders liquidating their stakes. This raises important questions about the company's long-term growth potential. As an investor, you need to carefully weigh the promise of Office against the competitive pressures in the co-working market. The landscape is evolving rapidly, and while the numbers look appealing, understanding the risks is essential. Edelweiss Financial Services Limited is currently offering 20 lakh secured redeemable non-convertible debentures, each priced at Rs 1,000, totaling a substantial Rs 2,000 million. These NCDs come with a CRISIL A+ Heart Watch negative rating, which signals potential risks that investors should be aware of. While the secured nature of these debentures provides a layer of safety, it's crucial to delve into the underlying assets backing them. The negative watch status suggests that there could be changes ahead that might impact their stability. Before making any investment decisions, take the time to thoroughly assess these factors. Understanding the risks involved will empower you to make informed choices in your investment journey. Hero Motors Limited is set to launch an IPO of up to Rs 9,000 million, with Rs 5,000 million earmarked for fresh issues. This move is backed by the esteemed Hero Group, positioning itself strategically in the booming automotive components and electric vehicle markets. The potential for growth here is significant, especially as the demand for innovative and sustainable solutions in transportation continues to rise. However, as with any investment, it's crucial to consider the risks involved. Market volatility and fierce competition could impact performance. So, while the prospects are promising, a careful evaluation of these factors is essential for any investor looking to capitalize on this opportunity. Investing in Oswald Pumps Limited offers a compelling opportunity, but it's crucial to dive into the details. Their IPO features a fresh issue of up to Rs 10,000 million, alongside an offer for sale from promoter Vivek Gupta. Operating in key sectors like agriculture and infrastructure, the company certainly has potential. However, we must acknowledge the risks involved. This is their first public offering, meaning there's no historical stock performance to analyze, which can make decision-making tricky. Additionally, a substantial portion of the funds raised will go to selling shareholders rather than fueling company growth. As investors, we need to weigh these factors carefully before jumping in. Investing in the International Gemological Institute India Limited is not a decision to take lightly. They're looking to raise 40,000 million, with 12,500 million earmarked for growth and 27,500 million coming from existing shareholders. The gemstone market is indeed thriving, but this is their first public issue, which adds a layer of uncertainty. Before you jump in, consider your risk tolerance. Are you comfortable with the potential volatility that comes with new ventures? While the allure of gemstones can be enticing, remember that every investment carries its risks. Do your homework, weigh the pros and cons, and ensure that your financial strategy aligns with your comfort level. Proceed with caution. The glittering market can sometimes hide sharp edges. Unimek Aerospace and Manufacturing Limited is set to launch an IPO worth $5,000 million, with half of that amount coming from new equity shares and the other half from an offer for sale. This company is diving into the aerospace components sector, focusing on the rapidly growing defense and aviation markets. The growth potential is certainly enticing, but it's important to tread carefully. This is Unimek's first public offering, and a significant portion of the funds raised will primarily benefit existing shareholders rather than fueling expansion. As an investor, it's crucial to assess your risk tolerance and stay updated on pricing details before making any commitments. Remember, informed decisions are key in the world of investing. Reliance Industries Limited has showcased remarkable financial growth in FY 2023-24, with a consolidated revenue of R10,122 crore, marking a 2.6% increase, and a profit after tax of R79,020 crore, reflecting a solid 7.3% rise. The company is clearly on a strong operational trajectory. The retail and digital services segments are thriving, underscoring Reliance's robust market positioning. However, as potential investors, it's crucial to remain vigilant about global economic fluctuations and regulation that could impact future performance. Staying informed and cautious can help navigate the complexities of this dynamic market landscape. NTPC Green Energy Limited is presenting an exciting investment opportunity, raising up to $100,000 million to expand its renewable energy footprint, particularly in solar and wind projects. With the backing of NTPC Limited and strong support from the Indian government, this venture is positioned for growth in a sector that's booming. However, as a first-time public offering, it's essential to consider the inherent risks, such as market volatility and increasing competition. Balancing these factors is crucial. The potential for sustainable growth in India's renewable energy landscape is immense, and with careful evaluation, this could be a strategic addition to your investment portfolio. Investing in Fabtech Technologies Limited could be a compelling opportunity. Their IPO is set to offer fresh equity shares, and the funds raised will directly support expansion in the burgeoning pharmaceutical engineering and cleanroom technology sectors. This is a market ripe for growth, driven by increasing demand for advanced healthcare solutions. However, it's essential to approach this investment with caution. It carries inherent risks and market uncertainties that could impact performance. While the potential for significant returns exists, due diligence is crucial. Balancing optimism with a clear understanding of the risks will be key for any financial analyst or advisor considering this opportunity. Casagrande Premier Builder Limited is set to launch an IPO worth $11,000 million, blending fresh equity with an offer for sale. This is a significant move, especially for investors looking at the booming real estate sector in South India, with a strong focus on Tamil Nadu. The company has established itself as a key player, thriving in a competitive market. However, as with any investment, it's crucial to weigh the potential for growth against the inherent risks. Market volatility and economic shifts can impact performance, so thorough assessment is essential. Keep an eye on this opportunity, but remember to invest wisely. Ellenberry Industrial Gases Limited is making a significant move by re-entering the capital market with an IPO of up to $4,000 million. Founded in 1973, this company has been a key player in producing essential industrial gases like oxygen and nitrogen, which are crucial for industries such as healthcare and steel manufacturing. The growth prospects look promising, especially with plans for expansion and debt repayment, signaling potential for future growth. However, investors should tread carefully. The company has a history of delisting, and competitive pressures in the market are ever present. Additionally, the substantial offer for sale by promoters raises some red flags. Balancing these factors will be essential for making an informed investment decision. Investing in PMEA Solar Tech Solutions Limited could be a game changer in the renewable energy sector. With a fresh issue of up to Rs 6,000 million and over 11 million shares available, this IPO stands out. The company focuses on solar plant components, positioning itself perfectly as India embraces sustainability. However, it's essential to tread carefully. This is their first public offering, and the competitive landscape is fierce. The promoters are selling shares, which suggests a partial exit strategy. While the potential for growth is significant, understanding the risks involved is crucial. This opportunity could align well with the growing demand for clean energy, but due diligence is key. Ather Energy Limited is making waves with its upcoming IPO, aiming to raise up to Rs 31,000 million to accelerate its growth in India's booming electric vehicle market. Backed by heavyweights like Hero MotoCorp, Ather is well positioned to capitalize on the increasing demand for sustainable transportation. However, let's not overlook the competitive landscape. Established players and new entrants are all vying for market share. This is Ather's first public offering, which adds an element of risk. As an investor, it's crucial to assess your risk tolerance carefully. Are you ready to ride the wave of innovation, or do you prefer to wait on the sidelines? The choice is yours, but the electric vehicle revolution is charging ahead. Investing in quality power. Electrical Equipments Limited could be a compelling opportunity for those eyeing the IPO market. With an impressive IPO size of Rs 2,250 million, this company is strategically positioned to meet the demands of India's expanding infrastructure. They specialize in manufacturing essential electrical equipment, which is crucial as the country continues to grow. What stands out is their commitment to expansion and a clear focus on reducing debt, which could enhance their financial stability. However, it's important to remain vigilant about cyclical risks that can impact the industry. Additionally, the promoter's partial exit raises some questions about long-term confidence. Investing in DAM Capital Advisors Limited is a decision that requires careful thought. They're offering 32 million shares from existing shareholders, but there's no fresh capital coming in for growth. While the investment banking sector is thriving, this IPO comes with its own set of risks. The lack of historical performance makes it hard to gauge future success, and the competition is fierce. Before diving in, it's crucial to assess your risk tolerance. Are you ready to navigate the uncertainties that come with this investment? Take a moment to weigh the potential rewards against the risks involved. Your financial future deserves that level of scrutiny. Regreen Excel EPC India Limited is stepping into the spotlight with an IPO that raises Rs 3,500 million in fresh equity. This company is positioned in the booming EPC sector, specifically targeting renewable energy projects. While the green energy market is on the rise, it's crucial to note that a significant portion of this IPO will benefit the promoters. As this is their first public offering, potential investors should carefully assess their growth plans and the current market conditions. If you believe in the future of sustainable energy and are willing to navigate the associated risks, this IPO could be an intriguing opportunity worth considering. Hexaware Technologies is set to launch an IPO with an impressive offer size of Rs 99,500 million. But there's a catch. This capital is coming entirely from promoter CA Magnum Holdings. This means no fresh funds for growth, which raises some red flags about future expansion. While Hexaware has a strong reputation in digital and cloud services, we need to tread carefully. The absence of new capital could limit their ability to innovate and compete. Plus, the potential for stock volatility is a real concern, especially with the promoter's exit looming. As investors, we must weigh these risks against the company's strengths before making any decisions. It's crucial to stay informed and cautious in this dynamic market. Ventive Hospitality Limited is launching an IPO to raise $20,000 million through a fresh equity share issue. This strategic move is aimed at fueling our expansion in the hospitality and real estate sectors, focusing on premium properties in prime locations like Pune, Bengaluru, and the Maldives. As the hospitality industry rebounds post-pandemic, particularly in the luxury segment, our positioning is set to capitalize on this growth. However, it's essential to remain vigilant about occupancy rate fluctuations and economic sensitivities that could impact performance. Investing in Ventive means being part of a promising recovery journey in a dynamic market. Outcomes Drugs and Pharmaceuticals Limited is set to launch an IPO, offering over 10 million fresh equity shares to raise $6,800 million. This company has carved a niche in contract manufacturing for major pharmaceutical firms, positioning itself in a sector that shows significant growth potential. However, as investors, we need to consider a few critical factors. The promoters are partially exiting, which raises questions about their long-term commitment. Additionally, new listings inherently come with risks, including market volatility and the company's ability to deliver on its promises. While the pharmaceutical sector is promising, it's essential to weigh these factors carefully before making any investment decisions. Sandstar Limited is set to launch an IPO with a substantial offer size of $101.50 million, which includes fresh equity shares and an offer for sale by its promoters. Operating in the agro-processing sector, Sandstar specializes in maize-based products, a market that's experiencing significant growth. The funds raised will be pivotal for business expansion and debt repayment, positioning the company for long-term success. However, potential investors should be mindful of certain risks, such as the dependency on maize pricing and the promoter's partial exit from the company. Despite these concerns, the long-term growth potential in the maize products market makes this IPO an intriguing investment opportunity for those looking to tap into the agricultural sector. Vraj Iron and Steel Limited is set to offer 8.26 million equity shares, aiming to raise Rs 1,710 million to enhance its production capabilities. This is a significant move, especially as the company focuses on TMT bars and sponge iron, positioning itself strategically within the booming infrastructure sector. However, as an investor, it's crucial to weigh the cyclical nature of the steel industry. Market fluctuations can impact profitability, so understanding these risks is essential. While the growth potential is promising, staying informed about market dynamics will help you make a sound investment decision. Schloss Bangalore Limited is set to launch an IPO worth $50,000 million, blending fresh equity with an offer for sale from its promoters. As a significant player in India's luxury hospitality sector, they stand to gain from the surge in tourism. However, it's essential to tread carefully. A substantial portion of the funds raised won't directly support company growth. This marks their first public offering, so we lack historical stock performance to guide our decisions. While the luxury market appears promising, we must remain vigilant about potential economic downturns and increasing competition. Investing here could be a gamble, so weigh the risks and rewards carefully. Investing in BMW Ventures Limited's upcoming IPO presents an intriguing opportunity. They're offering up to 2.34 core equity shares with a clear focus on expanding their financial services in Bihar. This region is experiencing significant growth, and BMW Ventures, promoted by the Kishore Puria family, is strategically positioning itself to capitalize on this momentum. However, it's essential to remember that this is their first public issue. While the potential for growth is enticing, it's crucial to weigh the risks involved. New ventures can be unpredictable, So thorough research and careful consideration are key before diving in. Keep an eye on this one. It could be a game changer in the market. Tata Consultancy Services has reported impressive revenue of R240,393 crore for FY 2024, reflecting a solid 6.8% growth. With operating margins at a robust 24.6%, TCS showcases its strong profitability. The company is not just resting on its laurels, it's strategically focusing on emerging markets and sectors like manufacturing and healthcare. Their commitment to innovation is evident in their substantial investments in AI and cloud technologies, alongside training over 300,000 employees to stay ahead in the tech landscape. For investors, TCS stands out as an attractive opportunity, combining stability with growth potential in a rapidly evolving market. HDFC Bank's financial highlights for 2023-24 are truly impressive. With a balance sheet size soaring to Rs17,623 crore, the profit after tax has surged to an astounding Rs60,812 crore. This remarkable growth is further bolstered by the strategic merger with HDFC Limited, significantly enhancing its market position. Moreover, HDFC Bank is making substantial investments in technology, which not only streamline operations, but also improve overall efficiency. Their commitment to sustainability is commendable, positioning them as a forward-thinking institution. For investors, HDFC Bank presents a compelling opportunity, combining robust financial performance with a strong vision for the future. This is a bank that is not just growing, but evolving in a rapidly changing landscape. ICICI Bank's integrated annual report for FY 2024 reveals remarkable financial growth, with a profit after tax soaring to $408.88 billion, a significant 20.2% increase year-on-year. This is performance by their robust focus on digital transformation, as they now handle over 160 million transactions daily. Such efficiency not only enhances customer experience, but also positions ICICI Bank as a leader in the banking sector. Moreover, their strong balance sheet reflects prudent financial management, while their commitment to sustainability goals cases a forward-thinking. For investors, ICICI Bank opportunity, financial results with innovative strategies that promise future growth. ICICI Bank's integrated FY 2024 reveals remarkable financial growth, with a profit after tax soaring to worth $408.88 billion, a significant 28% increase year-on-year. This impressive performance is underpinned by their robust focus on digital transformation, as they now handle over 160 million transactions daily. Such efficiency not only enhances customer experience, but also positions ICICI Bank as a leader in the banking sector. Moreover, their strong balance sheet reflects prudent financial management, while their commitment to sustainability goals showcases a forward-thinking approach. For investors, ICICI Bank presents a compelling opportunity, combining solid financial results with innovative strategies that promise future growth. Bharti Airtel's financials for 2023-24 are impressive, showcasing a revenue of R1,499,124 million, marking an 8% year-on-year growth. Their EBITDA reached R790,458 million, reflecting a solid 10% increase, which is quite remarkable in today's competitive landscape. The net profit stands at R74,670 million, and the EBITDA margin is a robust 54.3%. This strong performance is underpinned by their aggressive 5G expansion and innovative digital solutions, positioning Airtel as a compelling investment opportunity. With these results, it's clear that Airtel is not just keeping pace, but is also setting the stage for future growth. Infosys has truly showcased remarkable financial health in FY 2024, with revenue soaring to Rs53,670 crore, it's clear that the company is on a solid growth trajectory. An impressive 8.9% increase in net profit reflects their effective management and strategic focus. The operating margin, standing strong at 20.7%, highlights their efficiency and resilience in today's competitive landscape. What's even more exciting is the 35.3% growth in dividends, signaling a commitment to returning value to shareholders. With strategic investments in AI and cloud technologies, Infosys is not just keeping pace, but is poised for substantial future growth. For investors looking for a compelling opportunity, Infosys is undoubtedly a choice worth considering. In the fiscal year 2023-24, Life Insurance Corporation of India has truly set a benchmark with remarkable financial performance. With a total income soaring to Rs 8.53 lakh crore and a net premium income of Rs 4.75 lakh crore, LIC's market presence is undeniably strong. They've paid out an impressive Rs 3.88 lakh crore to policyholders, settling over 22 million claims, which speaks volumes about their commitment to customer satisfaction. Their total assets now stand at Rs 52.85 lakh crore, showcasing solid financial health. Holding nearly 59% market share in first-year premiums, LIC continues to lead the industry. For investors, these figures not only highlight LIC's stability, but also its potential for growth in a competitive market. ITC Limited's 2023-2024 annual report showcases remarkable financial performance, with revenue surpassing Rs 69,446 crore and a profit after tax of Rs 20,122 crore. This impressive profitability underscores the company's strong market position. What sets ITC apart is its diversified portfolio across 12 segments, ranging from FMCG to hotels, which mitigates risks and enhances growth potential. Their unwavering commitment to sustainability is evident in their initiatives aimed at reducing carbon footprints and promoting responsible sourcing. Coupled with a focus on innovation, ITC is not just adapting to market changes, but leading them. For investors and financial analysts, this positions ITC as a compelling opportunity for long-term growth. Hindustan Unilever Limited's annual report for 2023-24 showcases a remarkable financial strength, with a revenue of Rs 59,579 crore and a profit after tax of Rs 10,114 crore. The EBITDA margin stands impressively at 23.8%, and earnings per share are at Rs 43.05, highlighting HUL's robust performance. With a market presence that reaches 90% of Indian households, HUL is not just a leader, but a household name. Their commitment to sustainability is evident as they aim for net zero emissions by 2039. Additionally, HUL is innovating in premium products and enhancing their digital commerce strategy. This blend of stable performance and forward-thinking positions HUL as a compelling choice for investors and shareholders alike. Hindustan Unilever Limited's annual report for 2023-24 showcases a remarkable financial strength, with a revenue of Rs 59,579 crore and a profit after tax of Rs 10,114 crore. The EBITDA margin stands impressively at 23.8%, and earnings per share are at Rs 43.05, highlighting HUL's robust performance. With a market presence that reaches 90% of Indian households, HUL is not just a leader, but a household name. Their commitment to sustainability is evident as they aim for net zero emissions by 2039. Additionally, HUL is innovating in premium products and enhancing their digital commerce strategy. This blend of stable performance and forward-thinking positions HUL as a compelling choice for investors and shareholders alike. Larsen & Toubro has truly made waves in FY 2023-24, reporting a remarkable revenue of Rs 21,113 crore, which is a 21% increase from the previous year. Their profit after tax has surged to 13,059 crore, reflecting a 25% growth. These figures are not just numbers, they signify a robust financial health and a promising future. With an impressive order book of R4 75,809 crore, L&T is well positioned for sustained revenue generation. What sets L&T apart is its commitment to global diversification and sustainability, particularly through renewable energy projects. Their significant investments in digital transformation demonstrate a forward-thinking approach that aligns with modern market demands. Plus, a dividend of R34 per share adds to the appeal for investors looking for solid returns. Coal India Limited's annual report for 2023-2024 is impressive, showcasing revenues of Rs 142,323.98 crore and a profit before tax of Rs 48,812.61 crore. This reflects robust earnings and a strong market position. With a 10% growth in coal production, the company continues to solidify its dominance in the energy sector. What's more, it has maintained a consistent dividend for 14 years, highlighting its financial stability. For investors, this represents a solid opportunity to engage with a key player in India's energy landscape. Plus, with ongoing sustainability initiatives and a target of 1 billion tons production by FY 2026, Coal India is not just about profits, it's about a sustainable future in energy. Vedanta Limited's FY24 integrated report reveals a compelling financial narrative. With revenues soaring to R141,193 crore and an impressive EBITDA margin of 30%, the company clearly demonstrates its robust financial health. Its diverse operations in zinc, oil, and aluminium position Vedanta as a formidable player in India's resource sector. What sets it apart is its commitment to ESG goals, particularly the ambitious target of achieving net zero emissions by 2050. This commitment not only enhances its market appeal, but also aligns with the growing investor focus on sustainability. However, potential investors should remain vigilant about risks, particularly commodity price fluctuations and debt management. Balancing these factors is crucial for making informed investment decisions in this dynamic landscape. Indian Oil Corporation presents a compelling investment opportunity. With a record profit of Rs 39,619 crore in FY 2023-24 and a solid debt-equity ratio of 0.66, the company clearly demonstrates its financial strength. Their ambitious vision for a $1 trillion valuation by 2047, with a strong focus on renewable energy and sustainability, signals significant growth potential. However, it's crucial to remain aware of risks such as oil price volatility and regulatory changes that could impact performance. By balancing traditional oil and emerging energy solutions, Indian Oil is positioning itself to deliver long-term value for investors. This strategic move could be worth considering for those looking to invest in a resilient and forward-thinking company. Bharat Petroleum Corporation Limited has showcased an impressive financial performance, reporting a revenue of Rs 5,993 crore and a net profit of Rs 26,859 crore. Their gross refining margin stands at $14.14 per barrel, the highest among public sector oil marketing companies, highlighting their operational efficiency. With a remarkable return on capital employed of 34.07%, BPCL is not just thriving but also generating strong cash flow. Strategically, they are investing Rs 1.70 lakh crore over the next 5 years, focusing on key sectors like refineries, gas distribution, and green energy. Their ambitious goal of achieving $2 GIA of renewable energy by 2025 positions them as a leader in India's biofuel initiative. VST Industries Limited has delivered impressive financial results, showcasing a revenue growth of nearly 10%. While net profit experienced a slight dip, the company remains committed to its shareholders with a robust dividend of Rs 150 per share. This reflects their strong market presence and dedication to enhancing their brand portfolio through innovation. Additionally, VST is making strides in sustainability, aiming for a remarkable 50% renewable energy mix by 2030. This commitment not only positions them as a responsible player in the industry, but also aligns with the growing investor demand for sustainable practices. VST's focus on growth and sustainability makes it an intriguing option for investors looking for long-term value. Exchanging solutions. Limited has reported a notable revenue increase, reaching 19,625 lakhs this year. However, it's important to address the significant drop in net profit, which has fallen to 1,370 lakhs from 4,490 lakhs. Despite this decline, XSL continues to offer a healthy dividend of Rs 30 per share, which is a positive sign for investors. The company is strategically focusing on IT services and emerging technologies, positioning itself to tackle challenges such as cybersecurity threats and evolving regulatory landscapes. For potential investors, evaluating XSL's recovery strategy is essential, especially given the increasing demand in the IT sector. Understanding how they plan to navigate these challenges will be key to making informed investment decisions. SMC Global Securities Limited is offering non-convertible debentures, or NCDs, with a base issue size of Rs 7,500 lakhs, which can expand up to Rs 15,000 lakhs. These are secured instruments that have received strong ratings from CRISIL and ICRA, signaling low credit risk for investors. This means you can potentially earn a steady return while having some peace of mind about your investment. However, it's crucial to keep in mind that market volatility and regulatory changes can impact your returns. So, before diving in, make sure to assess your risk tolerance and stay informed about the market landscape. Investing wisely is key to making the most of opportunities like these. Investing in Muthoot Fincorp's non-convertible debentures, or NCDs, presents a compelling opportunity for those seeking stability. With a solid CRISIL AA stable credit rating, these instruments offer a high degree of safety, making them an attractive option for cautious investors. The base issue size is right 10,000 lakhs, with the potential to expand up to 35,000 lakhs, indicating strong market confidence. NCDs promise fixed returns. It's crucial to assess your risk tolerance. Remember, even safe investments come with their own set of risks. So, if you're looking for a reliable way to grow your wealth, Muthoot Fincorp's NCDs could be worth considering. Investing in Muthoot Mercantile Limited's non-convertible debentures, or NCDs, presents an intriguing opportunity for those looking to diversify their portfolios. With a base issue size of Rs 7,500 lakhs and the potential to double to Rs 15,000 lakhs, these secured instruments come with a rating of IND BB